When people talk about investing, they usually mean shares. But what exactly is a share? A share is a unit of ownership in a company. When you buy one, you own a piece of that business, its risks, its profits, and its potential. Companies issue shares to raise money, and investors trade them every day on the stock markets like the ASX or NYSE. Today, we'll break down how shares work, how they're traded, and how you can start making sense of what they're really worth. Let's start with the basics. What exactly is a share? A share is a small piece of ownership in a company. When you buy a share, you're not just investing your money, you're becoming a part owner of that business. As a shareholder, you benefit in two main ways. First, if the company makes a profit and pays out some of that profit to owners, you may receive a payment called a dividend. Second, if the company grows and becomes more valuable, the share price can rise. That means if you sell your shares later, you might make a profit. So, why do companies sell shares? They do it to raise money from the public. Instead of borrowing from a bank, a company can sell pieces of itself to investors. This money helps them expand, develop new products, or grow the business. Shares are bought and sold on the stock market, where people like you and me can invest in companies we believe in. In short, buying shares means owning a slice of a business and sharing in its risks and rewards. Now let's talk about how you actually buy and sell shares. The first step is simple. You need a trading account. This could be through a bank or an online platform like SelfWealth, ComSec, or ShareSeas. You can use your computer or just your phone. Once you've set up your account, you search for the company you want to invest in. Every company has a code called a ticker, like BHP for BHP Group or AAPL for Apple. Then you decide how to place your order. A market order buys the shares at the current price straight away. A limit order lets you set the price you're willing to pay, and the trade will only go through if someone agrees to sell at that price. Once you've placed your order, the platform connects you with someone on the other side, another buyer or seller. If the prices match, the trade happens instantly. It all happens on the stock exchange, where thousands of trades take place every minute. You don't need a finance degree or a broker on the phone. Just a few clicks, and you're in the market. So, why do share prices go up and down all the time? It's all about supply and demand. If more people want to buy a share than sell it, the price goes up. If more people want to sell than buy, the price goes down. But what makes people buy or sell? A lot of things: company profits, future growth, interest rate changes, and even news headlines can all influence investor decisions. For example, if a company reports strong profits, people might rush to buy its shares, pushing the price higher. If there's bad news, like a major recall or leadership scandal, people might sell, causing the price to drop. Sometimes prices change just because of fear, hype, or emotion, not logic. That's why it's important to understand the real value behind a share, not just the price you see today. Now let's look at how investors try to figure out what a share is really worth. This is called share valuation. When you see a share price like $50 or $120, that's just what people are currently willing to pay. But is that price fair? Too high? Too low? That's where valuation comes in. There are three common ways investors value shares. Each one looks at the company's ability to make money, either now or in the future. The first method is the price to earnings ratio, or PE. This tells you how much investors are paying for every dollar of company earnings. For example, if a company earns $2 per share and its share price is $20, its PE ratio is 10. That means investors are paying $10 for every dollar of earnings. A lower PE might mean the share is cheap. A higher PE could mean it's expensive or that people expect a strong growth. The second method is called the dividend discount model or DDM. This is used for companies that pay regular dividends like banks or utility companies. It looks at the cash you'll receive as a shareholder and asks how much are those future dividends worth today? If the company is expected to keep paying stable dividends, the value of those payments can help estimate the share's value. The third method is the discounted cash flow or DCF approach. This method looks at all the cash a company is expected to earn in the future, then discounts that money back to today's value. It's a more detailed and flexible method, but it also depends on good forecasts. If you think the company will grow fast, the DCF value will be higher. If future cash flows are uncertain, it gets tricky. So, which method is best? It depends. Some investors use one, some use all three. What matters most is that you understand the business behind the share and have a clear view of where its money will come from. Remember, price is what you pay, but value is what you get. Thanks for watching. In this video, you learned what shares are, how share trading works, what causes prices to change, and how investors figure out what a share might really be worth. You now understand the basics from becoming a shareholder to thinking like one. Here at Cash Concepts, our goal is simple: to make finance easier to understand. We create knowledge based, plain English videos for students, beginners, and anyone wanting to build confidence with money. Coming up, we'll share more finance related content that breaks down complex ideas without the jargon. If this video helped you, please subscribe or share it with someone who's learning too. There's more to come, and we're just getting started.